Hey everyone, welcome to this tutorial on calculating the internal rate of return of an investment. I'm Owen. This little video is extra on some of our more in-depth analysis and valuation models where we covered things like relative valuation, earnings power value, discounted cash flow analysis, and many more. The reason I created this little video is because it's something that I have since begun to use a bit more in my investing process, and I had some questions on other techniques that one could use to value shares or businesses. Many of you will be familiar with the concept of the internal rate of return. Before we get stuck into it, just a reminder that this video is for educational purposes only, so pretty much, you might want to go back and read some more theory and do some more, study on the ideas behind valuation before you put a spreadsheet like this into action. As a reminder, for those of you who have watched along with our other series, you can download these spreadsheets from the Rask Finance website. Okay, so this is a quick and easy version of the internal rate of return to value a stock. If you're looking for something more comprehensive, you could refer to, say, the CFA textbooks. You might enroll in a master's program, take an online course or something like that. I'm going to use a very simple case study here. This case study doesn't align with the business which we have used for all the other videos, simply because this isn't a very simple and easy technique, and I feel like you could forecast your own earnings per share and dividend yields, etc. for the company in the case study using this template that I've got here. Okay, so what is IRR? In other words, IRR estimates the potential yield or return from an investment. It's different to the net present value or NPV because NPV gives you the value of the investment. So what we're looking at is the R in the IRR calculation or NPV calculation when NPV equals 0. If that sounds like finance gobbledygook, it's probably because it is. Basically, IRR is different to NPV because it does not include external effects, hence the word internal. So it doesn't include things like inflation or the cost of capital. You'll know from previous tutorials that we calculated the weighted average cost of capital here. And we used some alternative methods to calculate cost of capital for equity securities, which is the earnings yield, which is just right here. Now, obviously, that's quite low, but that was just a proxy or a simple back-of-the-hand calculation you can use. Anyway, so what is a checklist? What's a quick checklist for making sure you got this calculation right? Remember that a negative value should be first, so you should be using a negative value to indicate that you are outlaying capital to make an investment when you're using IRR. And keep an eye on the signs that you use, so the cash flows, whether they're cash inflows or cash outflows. If you've read some material on IRR, you'll know that if you have multiple signs, so like I say, a positive cash flow, then a negative cash flow, then a positive cash flow, then a positive cash flow, followed by a series of negative cash flows or cash outflows, you might end up with a few different IRRs. So remember just to keep the signs consistent as you go through this template. Okay, so what are we doing? Here we've just got a condensed income statement. So we have data in this column is from 2 years ago, a year ago, the current year, and then we've got 5 forecast years. Now, what we're starting with is the bottom of the income statement, otherwise known as net income or net profit, otherwise known as the bottom line. So you can see here that I've done a very simple forecast and assumed this company makes $2 billion, or made $2 billion of profit 2 years ago, or otherwise known as 2,000 million, hence the $M there. Then it grew profit a little bit. The profit went back in the current year, or it's going to go back slightly. Then in the next year, it's going to reach 2.25 million, 2.25 billion, 2.3 billion, etc. on to the 5th forecast year. Now you would get this from your income statement forecasts. So you forecast revenue, you forecast costs, expenses, tax, etc. And then you get to the bottom line. You can see the next row here has shares outstanding. That looks like, I'm going to say that's 1 billion. Yep. We've forecast here just 1 billion, or I've forecast just 1 billion shares outstanding. You could do this really academically, and you could use like the weighted average number of shares, but I mean, for all intents and purposes, you just use the ending figure for the shares outstanding. Remember, I've got a little note here that shares outstanding, if you're forecasting this into the future, this is likely to change over time because companies love to issue shares. I mean, sure, some companies do share buybacks, etc. But what we tend to see over time is a very modest rise in shares outstanding year over year because you have employee stock options, you have acquisitions, etc. I mean, if you remember back to some of the tutorials we've already done, that equity financing is, selling shares is a source of funding for public companies. So you can perhaps expect more of that to continue into the future. But for the sake of this example, I've kept it flat at 1 billion into the next 5 years. So by now you can probably see, and many of you will know, that if you get net income and you divide it by the number of shares outstanding, you have profit per share or earnings per share. You can see here that we've simply done a click and drag, and we've dragged the formula across to get to $2.73 in profit or earnings per share in the forecast year 5. Now, this is where we overlay some more assumptions. So more assumptions overlaid on other assumptions. Dividends per share. So we've forecast that the company didn't pay a dividend 2 years ago. It didn't pay a dividend a year ago. It's not going to pay a dividend this year. But in the next year, it will pay a 30 cents per share dividend, 40 cents per share the year after, 50 cents, 70 cents, and $1. Now, this is cash you receive. So if you're an investor, this would be a cash inflow. If you put yourself in the position of a shareholder, you would be receiving a cash inflow. Now, why would you forecast this? Where would you get this from? Remember, dividends are one part of the equation, or one part of the benefit of investing in public securities. The other is capital growth, so the share price going up. You might forecast this based on what management have said. So they might say we are targeting a payout ratio, which is this next line here, of say 36% in the future. They probably won't be that granular. They might say, well, we aim to pay up to 50% of our future cash or future profit as dividends. So that gives you the payout ratio. Another way you could back out or forecast what a company might pay in terms of dividends as a percentage of profit is you might look at competitors in industry. So if you have, say, a supermarket business, you might look at other supermarkets that are mature businesses, and you might say, yes, this company is a relatively new supermarket, but I think it's going to grow. And other supermarkets currently pay out about 40% of their profit as dividends back to shareholders. Therefore, by year 5, I estimate it will be paying almost the same amount of dividends as a percent of profit. This is another assumption. So as a general rule in finance, the more decisions you have to make, the more likely you are to get one wrong. So keep that in mind. Okay, so what have I done in this next line? This is a bit abstract, it's a bit unusual. So I've looked at the average price earnings ratio. You can go back to, I think it was the second valuation technique we did, which was relative valuation, and you can look at the calculation for price earnings ratios and other relative techniques. As you remember, most of them are based on the income statement. So it's effectively all I've done here is I've just taken, in this very simple example, I've assumed that the average price earnings ratio of this company 2 years ago was 10. A year ago it was 9, and in the current year it's 12. So you might get this data from a broker. So an online share broker might have data going back to, say, 5 or 10 years ago, showing the average price earnings ratio, or you could use an online database like Morningstar or Wall Street Journal or something like that. I've obviously just made these numbers up, but you can see here that this company trades at 10 times its profit, 9 times its profit, and 12 times its profit. So it's not a high PE stock. It doesn't have 30 times 30 times its profit. It's a relatively, I suppose, lowly priced company, which may be reflective of its growth. You can see here it's gone up 1 year in terms of profit, and then it's come back down. So you might say that this company isn't exactly a high growth stock, but it is growing nonetheless. Therefore, it doesn't deserve a PE ratio like a high-flying technology stock, but it may deserve a price earnings ratio in the low double digits. So a forecast a key assumption of the forecast here is that we're forecasting the valuation to expand over time. So we're saying that this year investors were willing to pay 12 times profit. Next year they're willing to pay 14 times. The year after that, 13 times, then 14 times, then 15 times, and it's going to hold at that from year 3 to year 5. And the reason why you might say this company deserves to trade at 15 times its profit as opposed to 12, 9, or 10 times its profit is because you can see here in our forecast, we've forecast growth for the business in terms of profit. So if a business is growing its profit relatively consistently and reliably, and I suppose this would be relatively quickly, you could say that other investors would be more likely to pay a higher price for a slice of this growing business. Obviously, we have seen what's happened in the past here for the last few years, and we can see that it's gone back slightly this year, but we're forecasting growth into the future. So this might be a really good time to buy because we think the company is down at the moment, but we think it's going to come back and its profit's going to keep growing and growing and growing. So in year 5, we forecast a price earnings ratio of 15. Now this is a key assumption. This is a very, very key assumption because this will make up the bulk of our forecast cash flows, which influences our IRR. Let me show you what I mean. Let's say we put in 10 here. So we think the business is going to trade, or the shares are going to change hands at 10 times their yearly profit in year 5. You can see here that the share price, or the average share price that we forecast, is $27.25. Now, if you compare that $27.25 to the current share price of $25, which I've just made up, you can see it's not that much higher, yet it's 5 years later. Typically when we're investing, myself, I would like to see a business grow faster than $2.25 in 5 years. So this is a key assumption. If someone in the future is not willing to pay more than 10 times the profit of the business, and the profit is growing at only this pace, then we may say that this is not a very fast-growing business. But this is all well and good to say, right? We're just forecasting numbers and we're just picking a number and we're just saying, oh yeah, 10 times. But how do we put some context around this? And this is where IRR comes in. So let's take that back to 15. What we're saying is we're going to invest in this business and it's going to cost us $25 per share to do that today. So we would have to outlay capital. We would have to outlay $25. That's the negative $25 you see in this cell right here. But then after a year, we're going to start receiving dividends, right? Because we've forecast the dividends up here. So that's a cash inflow. Those are individual cash flows coming to us as shareholders. So if we drop down another line here, the sum of cash flows, or what the shareholder can be expected to receive if we do this forecast, we've got a negative $25 because that's cash going out. We're paying for the shares to come into our portfolio, but then we'll receive 30 cents, 40 cents, 50 cents, 70 cents. And in the final year, and we're saying the assumption is here, is that we are going to sell in this year. So we are going to sell the shares after 5 years at this valuation, at 15 times earnings, and we're going to receive the final dividend. So the final share price, as you know, which we calculated here as the multiple of profit, which was $2.73 profit, multiplied by 15 equals $40.88. But we have to add to that the dividend because we're going to hang around and receive that final dividend. Now, as you can see, there's a lot of intricate details here that we could go into, but we're not going to. This is very simple. And it's sort of like a sanity check you can use for your other valuation techniques. So you can see here, I've plotted the cash flows on a graph here. If we go down a little bit, you can see the initial cash outflow in this blue cell, this blue bar right here. Then we've got some cash inflows year over year. You can see they're increasing slightly, very small on the graph. But in the final year, we have the sale price of the shares plus the dividend, which is this big one here. So what IRR does is effectively says, what's the annualized expected return if we outlay the cash, which is this cell right here, and in the chart down the bottom here, and then we receive these dividends. Plus, we sell the share at the end and receive that dividend based on the assumptions that we've forecast here. Well, the IRR calculation, which is simply IRR and then the sum of these cash flows, is 12%. So the estimated internal rate of return is 12% by investing in this share. So what does that mean? Well, it means that we're looking at getting a 12% return if all of these forecasts stack up. Now, if you've taken any of our other forecasts, any of our other videos and tutorials, you'll know that there's a lot of things that can go wrong, and there are many, many, many different inputs that can go into a spreadsheet, so they mean nothing unless they're right and they're well researched. But just based on pure mathematics, we can say that if we're expecting to receive a 12% return and the cost of capital, or what we've calculated is the implicit cost of investing that money in this risky asset is 13%, we would say that the expected return does not outweigh the cost of investing in this opportunity. So does the IRR exceed the cost of capital? No. Now, let's just change one thing. Let's say the cost of capital is 10%. We would say that the IRR exceeds the cost of capital, and therefore this might be a good opportunity. Now, some investors don't use this cost of capital as their hurdle, so to speak. Some investors will focus solely on the IRR and say, we expect to achieve a return of 15% on average over a very long period of time. So what a portfolio manager might do, for example, is they might say, we only invest in shares that offer a potential 15% or greater IRR. And they might say that regardless of the cost of capital. They might say that their assumption might be that 15% is enough to make a market-beating return over a long period of time. If we get 30 individual share positions and they each offer in excess of 15% IRR, then we're going to make money for our investors over time. So what are the key inputs here? Just in summary, we've got what we believe the average PE ratio is going to be, the payout ratio, which is a percent of profit because that influences the interim cash flows that we receive, plus obviously the forecast for profit. Dividends per share is probably, shares outstanding rather, is probably not such a key assumption, but it is one you have to factor in. So those are the key assumptions, but let's just change this and let's say that it doesn't end up selling for 15 times, it ends up selling for 10 times. You can see here that the IRR falls to 4%. What you might do to stress test your model is you might do 4 different assumptions. So you might say IRR at PE ratio, to do capital R, of 10, IRR at PE of 15, IRR at P price earnings ratio of, let's say, 5. We're in a genuine bear market. Let's put that at the top here. So we might, to stress test our model, we might say, okay, if we assume that the price earnings ratio is 5, what's the IRR? Well, it's negative 8%, so that's a bad, we probably wouldn't take that bet. Let's make this a little bit bigger. And a little bit more again. What about if it was 10%, or how about if it was 10%? The IRR would be 4%. And how about if we change that to 15, as it was? We know that it's 12%. So you can see here that we have 3 different scenarios where the forecast for the price earnings ratio greatly influences the outcome or the range of results. So this is where you as an investor or an analyst, you would have to go through and think about these things probabilistically. So not just in simple terms and putting the numbers into a spreadsheet, but actually thinking to yourself, what is the likelihood that the company will indeed trade at 15 times earnings? Or what is the likelihood that the company will achieve its profit forecasts? This can be very, very difficult to do, right? Because you have to not only forecast the company, you have to forecast what other people might be willing to pay for the business. So you can see here that this reminds us that investing isn't easy necessarily. Nonetheless, it can provide a very good yardstick for evaluating any share on the market, and it's a very simple model to run. You can do this with almost any business on the stock exchange, banks. You can do it with industrial companies. You can do it with technology companies. They may not have dividends, or at least that's what we've come to realize in recent times, that technology companies don't pay dividends, but you can still do it with an ending share price. And then you can stress test it or use some scenario analysis to really understand what the opportunity is in front of you. And you could even add some probability or some weightings to these outcomes, depending on your conviction as to the likelihood that those scenarios will play out. And then you can average them, and you could get a proper IRR, or more reasonable IRR, given the bear case, the bull case, and the base case. Well, I hope this video has helped. If you have any questions on the IRR or on any of our other tutorials, remember you can head to the Rask Finance website, or you can find me on Twitter with the handle @OwenRask. A great source, I should put it in here, @OwenRask. A great resource for anyone watching this tutorial is one of our podcasts, or a few of our podcasts that we've released recently, where I've interviewed some hedge fund managers and some long-only in share market investors who share some of their valuation process and techniques with us. So head on over to the Rask Finance website and be sure to find me online. All right, thanks for tuning in, and until next time, cheers to our financial futures.